Good morning, students. Welcome you once again on the topic Ind AS 101, first time adoption of Ind AS. So, students, in the last class, we have started Ind AS 101 and we discussed that why this standard has been taken at the end of, after completion of all the standards. And you guys have given the right answer that this standard has been taken at the end because for understanding this standard, you should have knowledge of all the other standard because this standard does not talks about any recognition criteria, measurement criteria. This standard only talks about while moving from Indian GAAP to Ind AS to Ind AS, what are the exemption, what are the exception, what are the methods, what are the process. So what is the procedure which needs to be adopted from for moving from accounting standard to Ind AS, right? So this is the theme of this standard. And in the last class, we have discussed that first thing we have discussed implementation roadmap, where we have discussed that there are 39 Ind AS and then there are 40 IFRS, right? 39 Ind AS, okay? And we discussed that previous GAAP means Indian GAAP. In Indian context, previous GAAP means IGAP, Indian GAAP. And Indian GAAP means accounting standard, which you have read in your CA Inter or IPCC classes, okay? Then we have discussed some key impact areas. So what are the key impact areas from AS to Ind AS? So changes in presentation of balance sheet, OCI and SOCI. If you will see Ind AS financial statement, you will find that the format of the balance sheet has been changed, right? Earlier it was first equity, liability, then non-current asset, then current asset in IGAP. But in Ind AS, it starts with asset. When you look at Ind AS balance sheet, you will find that asset comes first, then equity, then liability, right? Again, the second thing, which is statement of changes in equity. So this component was not there, although you were giving reserves reconciliation and equity reconciliation in the notes to accounts, but your SOCI as a component, what is meant by component? Component means where the document has been signed by board of directors and statutory auditor, right? Like balance sheet, like P&L. So we have to give statement of changes in equity as a separate component, right? So this is a new component in under Ind AS. Second, under Ind AS, there is a concept of other comprehensive income as well, right? The statement of profit and loss under IGAP is not same under Ind AS, right? Under Ind AS, it is different, right? Different means under Ind AS, it is more extended version of P&L. Why? Because other comprehensive income is included in that. I've just given some examples that why the standard is there, because there are differences between IGAP and Ind AS, okay? Second, if I talk about actuarial gains and losses, so if there is an actuarial gains and losses on defined benefit plan like gratuity, so these actuarial gains and losses should go to OCI as per Ind AS 19, right? Then the third one, which is very important and which has impacted almost every company of India, is your fair valuation of financial instrument, like majorly impact on investments, right? So all the listed companies of India, which is having investment in government securities, investment in mutual funds, investment in equity share of other companies, right? So these companies, investment have been fair value, right? Because either these investments are FVT OCI or FVTPL, and those impact has been taken to retained earnings at the date of transition. Decommissioning liability, although this is not a big change now because under IGAP, AS 29 has also been revised with effect from 1st April 2016. It's been 7 years, and under IGAP, this decommissioning liability is also going to be discounted, right? Discounting of long-term provision. So other long-term provision are not required to be discounted under IGAP, but it is discounted under Ind AS. Change in functional currency. I believe you guys have also read Ind AS 21, the effect of changes in foreign exchange rates, right? If you will look at the foreign exchange standard, you will find that, the concept of functional currency is there. In Indian GAAP, in AS 11, the concept was local currency. What is the meaning of local currency and what is the meaning of functional currency? For example, if a company has been incorporated into India, right? By virtue of its incorporation in India, the local currency will be INR, right? So now what is the difference between local and function? Same company which is incorporated in India but doing its entire business in Europe, let's say, right? So they are making their larger sales in Europe. They are incurring their larger cost in Europe. So in this case, geographically this company is in India, but economically this company is in Europe, right? This company is in Europe. If something happens in Europe, then the business will be impacted. The business of this company will be impacted. If something which is happening in India, it is not impacted. But if something which is happening in Europe, the business has been impacted. Means where this company is economically operating. This company is economically operating in Europe. So what is the functional currency? Functional currency is a currency of primary economic environment. So functional currency is a currency of primary economic environment. So in this case, the company which is an Indian company, the functional currency will become euro, right? It will become euro. Clear? Sir, in that case, if that company has to present financial statement in India, then whether it has to be presented in euro? Answer is no. In that case, there is another concept of presentation currency, and presentation currency can be chosen, right? You can choose your presentation currency. So in that case, the presentation currency will be INR, right? And euro has to be converted into INR. Okay, euro has to be converted into INR. So friends, there is a big difference between a local currency and functional currency, and in Ind AS and IFRS, the concept is functional currency. In IGAP, there was no concept of functional currency. There was a concept of INR. There was a concept of local currency, right? Equity consolidation instead of proportionate consolidation for joint venture. You are aware, in IGAP, the joint venture are consolidated using proportionate consolidation method, but in Ind AS, the joint ventures are consolidated using equity method. Leases, you are aware, under Ind AS 6116, from the lessee perspective, all the leases are required to be capitalized in the books of accounts, which is right of use asset and leasehold obligation. Revenue recognition, again 5-step model. The revenue recognition is bit lengthy. The revenue expenses is, the revenue recognition is substance based rather than form based, right? So the revenue recognition is very different from what we were doing under IGAP. Okay. Then we discussed why Ind AS 101. We discussed because there are a lot of differences between AS and Ind AS, and you guys have told me so many differences there, right? Then we have discussed that this standard talks about the procedure for the first time adopter. This standard also gives some mandatory exceptions and optional exemption, and this standard talks about where the difference will go on the transition date, right? Then we started reading some 5-step process. That Ind AS 101 is nothing, it's a 5-step process. The first one is identification of date of transition. Identification transition date. What is a transition date? So transition date is opening of the comparative date. Why transition date is required? Transition date is required because when you will convert from IGAP to Ind AS, you have to migrate. You have to convert your AS balances into Ind AS balances, right? For example, this is the current year when you have decided to move to IGAP, Ind AS. This is the current year. For current year, you have to give the previous year. But if you have to convert your previous year number into Ind AS, of course, you will requiring the opening of the previous year number to be converted into Ind AS. And this is known as a transition date, right? So whatever differences will be there due to moving from IGAP to Ind AS, the difference will go to the retained earnings, right? Then we discuss selection of accounting policies that comply with Ind AS, because your first Ind AS financial statement will be for 3 period. So question arises that whether the accounting policy should be one uniform and consistent across the first Ind AS financial statement. Answer is yes. Now the question arises, if two different standards were applicable during this 3 period, which standard has to be taken? So standard says that the latest standard has to be taken. Latest means latest on the reporting date, applicable on the reporting date. And this is logical also, because going forward, you have to apply that standard only, right? The third step which we started was preparation of opening Ind AS balance sheet. Standard says that 101 says that while preparing opening Ind AS balance sheet, means balance sheet on transition date, you have to recognize whatever has to be recognized as per Ind AS. For example, the classic example is biological asset. You remember that example of calf? You remember that example of calf and cows? Viraj, Smith, Koshiki, Pooja, Priyanka. Do you remember this example of cow and calf? Smith, I have already shared with Board of Studies this PPT. Yes, Pooja is saying yes, sir. So under IGAP, this calf is not accounted for, but under Ind AS, this calf is required to be accounted for on the basis of fair value less cost to sell, right? In this case, it has to be recognized. Okay. Kochiki has told that yes, sir, Soham has identified. Very good. Yeah. So whatever is required to be derecognized has to be derecognized as per Ind AS. When this Ind AS transition happened in 2016-17, majority of the listed companies who were dividend paying companies, they have derecognized the proposed dividend, because there is no concept of proposed dividend in Ind AS, right? The third one is measurement. What is meant by measurement? So basically, whatever is required to be measured as per Ind AS, so that has to be measured as per Ind AS. Okay, so measurement criteria is as per Ind AS. For example, under IGAP, a fair value is not allowed. Let's say investment, right? Investment was measured at cost or market value, whichever is lower in case of short-term investment. But in case of long-term investment, you have to keep it at cost, right? You have to keep it at cost. But under under Ind AS, it has to be measured at fair value, right? Classification. For example, preference share capital has to be classified as liability instead of equity. Okay. So recognition, derecognition, measurement, classification as per Ind AS. This we have discussed, right? You remember that, this part? You remember this part? Recognize all assets and liabilities required to be recognized by Ind AS. Derecognize all assets and liabilities not permitted by Ind AS. Classify all items in accordance with Ind AS. Measure all assets and liabilities in accordance with Ind AS. You remember this part? Yeah? Is it clear? I hope it is clear. This is clear now? Okay. Yeah. Let's start the next concept now. And the next concept was what we have discussed. Optional exemption and mandatory exception. For preparation of opening Ind AS balance sheet, this part we have discussed. Now we need to discuss optional exemptions and mandatory exceptions, right? So before starting that, let me discuss one small case study that how to do this transition, and then I'll go to the optional exemption and mandatory exceptions. And you remember last time we have discussed that why this is required, and we have discussed one example of Tata Steel Limited. That Tata Steel was incorporated in 1907, and they have purchased 4 buildings in the last 100 years, right? Starting from 1960 to 1980. And in 1985, they have revalued 1 building, right? And it was allowed at that point of time as per accounting standard. But now they have moved to Ind AS from the financial year 16-17, right? Comparative 15-16, transition date 1st April 15. Now, what is the general rule of gap transition? What is the general rule? Guys, what is the general rule? General rule क्या है? Sumit, what is the general rule? Viraj, what is the general rule? The general rule is to apply the requirement of new gap, apply the requirement of Ind AS since beginning. Means since the date when this item was recognized, item was acquired, right? Now, do you find it possible? Answer is no. So in that case, Ind AS 101 give you some breather. Ind AS 101 give you some tip, give you some magic. What is that magic? And what is the problem? The problem is, first of all, Ind AS says that if you are revaluing any asset, you have to revalue all the asset of that class, right? Now sitting in 1617 and revaluing the building which was acquired in 1960, the building which was acquired in 1972, the building which was acquired in 1980, and doing this revaluation in the year 1985 means 30 years ago. It is next to impossible task, right? It is next to impossible. It does not add any value. It does not make any sense, right? And it's a cost compulsive exercise as well. So friends, that is why Ind AS 101 has given some exception and exemption. If someone will come and tell you, no, I want to do that since last 30 years, do that. No one stops you. Even standard says that apply the requirement of the new gap, apply the requirement of Ind AS from the date of transaction retrospectively, right? But it is not possible for maximum companies. So that is why Ind AS 101 has given the optional exemption. Ind AS 101 has given the exemption like what you can do. You can do the fair valuation of the PPE on the transition date, right? So whatever is the fair valuation on the transition date, it will become your cost. And now you start Ind AS 16 accounting prospectively. Or whatever value is there as per IGAP, as per accounting standard 10 on the transition date, you can just assume that value as per the opening value of Ind AS, right? And after that, you can apply Ind AS 16. So this is what they have given, right? Kotiki is asking how Reliance revalued. Reliance has Reliance has fair valued their land which is besides in the vicinity of Jamnagar refinery plant. They have do the fair valuation. Reliance is a big company, they are a cash rich company. They have done the fair valuation. Whether my audio and video is all right? Friends, are you able to hear me properly? Mr. Ashok, can you please confirm on the chat box if the audio and video is all right? Okay. Yeah. Yes. Let's move on. Koshike has confirmed audible and visible. Very good. Even ICI support team has also confirmed that audio and video is doing fine. So Koshiki, they have revalued on the date of transition. They have done the fair valuation on the date of transition, right? Okay. Now let's discuss. We have discussed why Ind AS 101 is important, because Ind AS 101 has given you some relaxation, some exemptions, some exceptions. Okay. So before moving further, let's discuss a small case study, right? This is IGAP balance sheet. And I want you guys to please write down this problem with me. So this is IGAP balance sheet, and in IGAP balance sheet there is a share capital. If I talk about share capital, this is equity share capital, and this is preference share capital. Then there are reserves and surplus, and surplus. Then there is a non-current liability. Okay, under non-current liability, let's say there are some long-term borrowings from banks, long-term borrowings, and there is a current liability. Let's say trade creditors. So, for example, share capital, equity share capital is 10,000. Assuming these numbers are in lakhs. Okay, 5,000 is preferential capital, 15,000 reserves, 7,000 borrowings, trade creditors 3,000. This is the total of the balance sheet. Then coming to asset side, non-current asset, under the non-current assets, PPE, intangible asset, $4,500, let's say 5,000. Investment, $10,000. Then current asset, inventory, investment, your cash in bank, and trade receivable. Inventory is 5,500. Investment is 5,000. Cash in bank 10,000. Trade receivable 10,000. $10,000. Yes. 5,000, 5,000, 5,000. Yeah. I hope this is clear. This is IGAAP balance sheet. Now some additional information is given. Additional information. Information number 1. The fair value of long-term investment was, so long-term investment value is 10,000. So the fair value of the long-term investment was 14,200 on the transition date. Second, the fair value of the short-term investment, the fair value of the current investment, the fair value of current investment was 7,500 on the transition date, right? Third, the company has 4 cows which was not recorded in the balance sheet due to the fact that these calves were born by the mother cows who were in the IGAP books earlier. Now, mother cows got died and hence no biological asset in balance sheet. Right. The fair value less cost sell of these 4 cows are 10,000. Tax rate is 30%. Prepare Ind AS transition date balance sheet. I hope the information is clear to all of you. I hope this information is clear to all of you. Yeah. I hope this balance sheet is clear to all of you. Now I am telling you the practical part of it, right? We need to prepare this Ind AS balance sheet, right? Let's say this balance sheet is on the date of transition. This is IGAP balance sheet. These are the IGAP numbers, and we have to convert this IGAP balance sheet into Ind AS balance sheet. How should we cover this? How will we convert this IGAP balance sheet to Ind AS balance sheet? First of all, let's prepare Ind AS balance sheet at transition date. And here we will prepare the reconciliation, right? Reconciliation. In Ind AS balance sheet starts with non-current assets. Under non-current asset, first of all, this PP will be there and intangible asset will be there, right? No information has been given for PP or intangible asset, right? So this is IGAP number. First of all, this number is IGAP number. I'll write this as a IGAP. I'll write this column as a Ind AS adjustment. Ind AS adjustment. And this one is Ind AS final number. Okay. As far as PP is concerned, no adjustment is there. Intangible asset, no adjustment. This number will flow to Ind AS directly, right? There is no adjustment given for PP or intangible assets. Probably the company has carried value, has carried the same value which is there in IGAP. Then there is a investment, right? Investment has to be shown as financial asset. Investment. So this is your financial asset. Financial asset. Investment, right? Long-term investment, it is written that because this long-term investment has been valued at cost. The cost is 10,000, but the fair value is 15,200, right? For this long-term investment. So we have to recognize a gain of 4,200, right? Gain means upside of 4,200. And what will be the accounting entry here? The accounting entry will be long-term investment account debit. Account debit. To what? There is no opening P&L, to retained earnings. 4,200 and 4,200. And along with this, you have to pass a deferred tax impact as well. What will be the deferred tax impact? The deferred tax impact will be deferred tax. On this deferred tax, liability needs to be created. Retained earning account debit. Retained earnings account debit. Creating an asset, so there will be a deferred tax liability. Retained earnings account debit to deferred tax liability. To deferred tax liability. Liability, right? Have you understood how I am passing the accounting entry and what I am doing? I'm showing you how practically this Ind AS balance sheet is going to be prepared, right? Okay. So deferred tax, we have taken the impact of 4,200 in the financial asset. Now let's move forward. Current asset. On the current asset side, these information is also given. So inventory, investment, cash in bank, and trade receivable. These investment, cash in bank, and trade receivable is financial asset. Okay. Investment. Now it is written that short investment, the value of the short-term investment, current investment is 7,500 on the transition date. Will upside this by 2,500 and it will become your 7,500. Inventory, no any information is given. We will assume that inventory is of the same value, right? Cash in bank and trade receivable, no information is given. So we'll assume the same amount. Okay. What is the accounting entry for short-term investment? Current investment account debit. Account debit to retained earnings by how much amount? 2,500. 2,500. Same entry, retained earnings account debit to deferred tax liability. 30% of 2,500 and 30% of 2,500. Right? Now the third information is given. There is a biological asset also. There is a biological asset also which is not there in the balance sheet. This biological asset will be your non-current asset. Biological asset. 0 in IGAP it was 0. 10,000 will be the Ind AS value, right? So under Ind AS balance sheet, this will come as a 10,000. So what is the accounting entry for biological asset? For biological asset, the accounting entry will be biological asset account debit to retained earnings account. 10,000. 10,000. Right? And again, an accounting entry of deferred tax liability. Deferred tax will also be there. What is the accounting entry? Retained earning debit to deferred tax liability. 10,000 multiplied by 30%. These are the Ind AS adjustments, right? Now let's do the total of the asset side. Total assets. This becomes 56,700. Now let's go to the liability side, right? Let's go to the liability side. First of all, this preference share capital, so share capital, equity share capital, right? This preference share capital will become your part of non-current liability. Okay, this will become part of the non-current liability. Second, this reserves and surplus is known as other equity. Other equity. Okay. And this non-current liability also becomes a financial liability. Financial liability. So there is a classification between financial and non-financial also in Ind AS. Financial liability, financial liability. Right. Now in equity share capital, there is no change, right? It will be your equity share capital only. But as far as other equity is concerned, in other equity, there is a change. Your opening retained earning, opening reserves and surplus in IGAP was 15,000, right? So what is the value of this other equity? Calculation of other equity, right? means retained earnings, calculation of retained earnings. RE as per IGAP. RE as per IGAP was 15,000. Now it will be increased by long-term investment and deferred tax impact. Deferred tax impact. By long-term investment, it will increase by 4,200 credit, but there is a debit of 1260 due to the deferred tax. Again, current investment, there is an increase of 2,500, but the deferred tax impact, there is a decrease of 750. Biological asset, there is an upside of 10,000, but there is a downside of 3,000 also on account of tax. Now, what is the total adjustment? The total adjustment is how much? 11,690. And what is the total equity, total retained earning, total reserves and surplus in Ind AS? 26,690. 11,619 is the adjustment. 690 is the adjustment. Total is 26,690. There is no change in borrowings and preferential capital. There is no change in trade creditors. You can see your number will not tally, right? You can see there is a difference. In IGAP balance sheet, there is no difference. Why there is a difference? In Ind AS adjustment, there is a difference of 5,010, and same number is difference in your Ind AS balance sheet. See, there is one deferred tax liability as well, right? Deferred tax liability as well. So the next one will be deferred tax liability. Sorry. Deferred tax liability. Right? A liability has also arisen. There was no deferred tax liability. Now, how much is the deferred tax liability? How much is the deferred tax liability? 1,000 on account of biological asset. DTL credit plus DTL credit plus DTL credit. The total liability is 5,010. Right. Now you can see this balance sheet got tallied. Friends, have you understood how we are converting from IGAP to Ind AS by using the recognition, derecognition, classification, and measurement concept, right? We have recognized biological asset, we have measured biological asset, we have recognized, we have remeasured investment at fair value, right? We have reclassified preference share capital. Have you seen this? Let me know if you have any doubt. I have given you the accounting entries, the deferred tax impact, and I have shown you the IGAP, Ind AS adjustment, and Ind AS as well. I have shown you the reconciliation also. And this is how practically it is prepared. So let me show you the Hindustan Unilever balance sheet. Please let me know if the Hindustan Unilever balance sheet is visible. Is it visible? Hindustan Unilever. Whether Hindustan Unilever balance sheet is visible? This is their first time adoption note. You can see. This is equity reconciliation, which I have told you, but this is how they have prepared the balance sheet as on transition date. So basically, it's a reconciliation. This is your previous gap number, which is IGAP, Ind AS adjustment, and Ind AS numbers, right? So this is how this reconciliation is going to be prepared. Are you okay with this practical example? Are you okay with this? Have you understood how the balance sheets are getting prepared from IGAP to Ind AS? Yeah. Okay. Now let's discuss the optional exemption and mandatory exceptions, right? So this is the practical balance sheet. So Ind AS conversion balance sheet. Yeah. I hope it is clear to all of you. Is it clear? Okay. Very good. Now let's go to the exceptions and exemptions. Friends, there are two kind of relaxation given in the standard. Mandatory exceptions, as the word suggests, mandatory, and optional exemption, as the word suggests, optional. Right? Means you need to choose. If you want to avail, you can avail. If you don't want to avail, there is no compulsion. Right? Again, I'll start the concept with the example of Tata Steel. Tata Steel was a company which was formed in 1907. Right? Ind AS was applicable on this company from 1st April 2016. That was the reporting year, right? Which is 16-17. Now comparative year was 15-16 and transition date is 1st April 15. What is the general rule? The general rule is to apply the provision of Ind AS from the beginning, that is from the date of transaction. But it is next to impossible task if someone will tell you that Viraj, you need to convert this balance sheet as per Ind AS and you need to take the impact from 1907. I can tell you even the records will not be available for the last 108 years, right? It is next to impossible task. Okay. So in this case, Ind AS 101 has given you some transition bridge. What is a transition bridge? Ind AS 101 has given you some magic. And this magic was in the form of optional exemptions and mandatory exceptions. This has given exemptions and exceptions. Exemptions means optional, exception means mandatory. Means any company which is moving from IGAP to Ind AS, those companies has to apply some relaxation on a mandatory basis. But there are some exemption which is optional basis. So there are 7 mandatory exceptions and there are 14-15 optional exemption, right? So these are the rules which is given in the standard. Wherever it is mandatory, it is a rule. Wherever it is optional, it is up to your choice, right? It is up to you. So Ind AS 101 says that you need to apply this exemption on the date of transition and you can start your life prospectively under Ind AS era, right? Clear? You are not required to look back for last 20 years, 30 years, 40 years, 60 years, 100 years. You have to apply these mandatory exception and optional exemption and you can move forward in your life, right? Clear? So I'll start with the first optional exemption, which is very important optional exemption. What is the optional exemption? First of all, business combination exemption. Do you remember Ind AS 103 business combination? Do you remember Ind AS 103 business combination? Yes. So in accounting standard, we do have AS 14 accounting for amalgamation. But Ind AS 103 is very wide in comparison to AS 14. Right? In Ind AS 103, first of all, it talks about fair value concept, right? That is the first one. That you have to do the fair valuation. Whenever you do any acquisition, on the acquisition date, you have to do the fair valuation of net assets, consideration, etc., etc. Right? So let's say today I'm sitting in 2022-23, and now today I want to convert my balance sheet into Ind AS. So if the current year is 22-23, what is comparative year? It is 21-22. What is transition date? It is 1st April 21. So I need to start my Ind AS journey from 1st April 21. And I did one acquisition 10 years ago, right? So now 10 years ago when I did that acquisition, I have passed the accounting entries on the basis of book value method because AS 14 permits that. But now since I am moving towards Ind AS, Ind AS says that you have to apply the provisions of Ind AS since beginning, right? So now the acquisition which I did 10 years back, I have to remeasure this entire acquisition at fair value. Is it possible that I'll go back in time and I'll compute the fair values which was there on 10 years ago? Is it possible that I need to remeasure that entire net assets which I have acquired 10 years ago, and I have to remeasure the contingent consideration, I have to remeasure the consideration, I have to revalue the goodwill again. Then for the 10 years I need to test the goodwill for impairment, right? Is it possible? Is it possible? Thank you, Sanjay, for your nice feedback. Is it possible? It is not possible. It is next to impossible, I would say. Next to impossible, right? So that is why Ind AS 101 has given some exemption on the transition date. So Tata Steel, formed in 1907, they have done more than 50 acquisitions, right, in their lifespan. For example, in 1910, 20, 30, 40, 50, 60, 70, 80, 90, 2000, 2010, 2014, they have done acquisition starting from 1910 to 2014. And the transition date is 1st April 2015. Now the company wants to convert from IGAAP to Ind AS. So if the company is converting from IGAAP to Ind AS, what are the options which are available? The first option. What is the first option? The first option is no option. What is the first option? The first option is apply this Ind AS 103 retrospectively. सर अगर ये ऑप्शन होता तो फिर 101 की जरूरत ही क्या होती है अगर यही ऑप्शन है. This is not possible. I cannot apply Ind AS 103 for the acquisition which I have done in 1910, 20, 30, 40, 50, 60, 70, 80, 90, 2000 even, right? 2010 or 2014 is very close to 2015. But these acquisitions I cannot do restatement of business combination. Standard says that don't worry. Don't worry. You can do one thing. Apply Ind AS 103 prospectively from a decided date. Sir, what is the meaning of this? For example, Tata Steel says that I have all the information available for the business acquisition which I have done in 2010. I want to apply Ind AS 103 on the 2010 acquisition. Standard says that Ind AS 101 says that if you want to choose any business combination restatement, you can do that. You can do that. But whatever business combination you are restating, right? You have to restate all the business combination after that date. Means if the company has decided to apply Ind AS 103, if the company has decided to apply Ind AS 103 on this 2000 acquisition, in that case, the company is required to apply Ind AS 103 all the business acquisition which has happened after 2010. Right? You can pick a date. You can choose a date, and after that date, all the business acquisition needs to be restated. So first, if you don't want to do retrospective, if you want to apply your Ind AS 103 accounting from any particular date, you can do that. So this option is also available. Third option, very, very, very easy option. Don't restate any business combination before transition date. Whatever numbers are there as per IGAAP, just take that number as an opening number, right? Means Tata Steel till 31st March 2015, whatever acquisition is done by Tata Steel has not restated any business combination before transition date. And let me tell you, 95% of the companies in India have not restated their business combination. Sir, why this retrospective is also there in option. The retrospective is an option because it is an optional exemption. If a company which is a new company, which has incorporated 4 years back, and just 2 years back they did 3 acquisition, and now they want to restate this business acquisition, they can do that. Or if a company which is a very old company, but recently they did some business acquisitions and they want to restate only those business acquisitions, so they can do that, provided whatever business acquisition they want to restate, they have to restate all the business acquisition after that as well, right? Or if company don't want to restate any business acquisition before transition date, it is also allowed, right? Is it clear? So let me show you again Hindustan Liver first time adoption notes, optional exemption from retrospective application. Please read this. Please read this note from Hindustan Unilever annual report. Ind AS 101 permits first time adopter certain exemption from retrospective application of certain requirements under Ind AS. The company has elected to apply the following optional exemption from retrospective application. Please read this. Business combination. Ind AS 103 business combination has not been applied to acquisition of subsidiary, associates and joint venture and transaction which are considered business for Ind AS that occurred before 1st April 2015, means before transition date. You can read that this company has not restated any business combination before transition date because they have taken the exemption. What exemption? Exemption number C. They don't restate any business combination prior to transition date. The carrying amount of assets and liabilities in accordance with previous GAAP are considered as the deemed cost, means opening value as per Ind AS. The carrying value of assets and liability in accordance with IGAAP are considered as the deemed cost at the date of transition, not acquisition, date of transition. After the date of acquisition, after the date of transition, measurement is in accordance with Ind AS. Read this acquisition as a transition. This is a wrong word. This is not acquisition, transition. Okay. The carrying amount of the goodwill in the opening Ind AS balance sheet is the carrying amount in accordance with IGAAP. So whatever numbers as per IGAAP was there, they have simply picked those numbers as an opening number under Ind AS, and they have not restated any business combination. This is what I'm showing you in the listed company, which is a very, very big listed company, Hindustan Unilever Limited. Right? Friends, are you enjoying this session? I'm showing you practically also. Yeah? Are you enjoying this session? No? Yes? Not applicable. Hindustan Unilever is an Indian company. It is incorporated in India. Listed in India, right? Is it clear? Shall I move forward? Have you understood this exemption? This is kind of exemption and exception given in this standard. This standard only talks about what you should do or what you should not do on the transition date. That's all. Second, this was your optional exemption. This was your optional exemption. Optional means it is at your choice. Second is mandatory exception. What is meant by mandatory exception? Right? Friends, you know that Ind AS 103. So Ind AS 103 is your, if I talk about Ind AS 103, Ind AS 103 is your acquisition date standard. Ind AS 103. It is the acquisition date standard. Whenever you are acquiring any company, then this standard is applicable. Right? This standard talks about how to compute minority interest, how to compute goodwill. But after that, on every reporting date, Ind AS 110 is applicable. Ind AS 110 is a reporting date standard. Ind AS 110 is a reporting date standard, right? And once you have done the acquisition accounting, then on every reporting date you have to do the consolidation accounting. And this 110 is related with Ind AS 103. What is the mandatory exception given in the standard? Let me tell you. Friends, first of all, what is the big difference between AS 21 IGAAP consolidation standard versus Ind AS 110? Ind AS 110, which is Ind AS consolidation standard. What is the difference? Right? What is the difference? The difference is in IGAAP, the non-controlling interest, the minority interest cannot be negative, right? In IGAAP, the NCI cannot be negative, right? But in Ind AS, NCI can be negative. If the company is running into losses, the portion of the losses has to be charged to the NCI as well, right? So again, I am taking this example of Tata Steel. So is it possible to go back in time and check and just restate the consolidation for the last 100 years, for the last 80 years, and just we need to restate this NCI every time, or we need to restate this entire consolidation for the last every reporting year? It is next to impossible, right? It is next to impossible. So Ind AS 110 says that provision of Ind AS 101 says that provision of Ind AS 110 will be applicable post transition date. It simply says that whenever you are doing Ind AS transition, the provision of Ind AS 110 will be prospective. Means you have to apply the consolidation related requirement as per Ind AS 110 from the transition date, means after the transition date. So whatever reporting date falls after transition date, only in those cases Ind AS 110 will be applicable. But I have told you 110 and 103 is a link standard. So 101 is saying that 110 provision will be applied prospectively after the transition date. But if you have restated your previous business combination, in that case, you have to restate the consolidation also. So it says that it will depend on the business combination exemption. What is meant by that? If a company has decided to apply Ind AS 103 retrospectively, in that case, apply the requirements of Ind AS 110 retrospective, right? If you can do this Ind AS 103 accounting retrospectively, then why can't you do this 110 accounting retrospectively, right? It is also depending on the business combination exemption. If the company is applying Ind AS 103 prospectively from a decided date, apply the requirement of Ind AS 110 prospectively from that date. Don't restate any business combination after the transition date. Don't restate any business combination before transition date. In this case, of course, standard itself says that Ind AS 110 will be applicable post transition date. In that case, don't apply Ind AS 110 prior to transition date. Have you understood this thing? Have you understood this exemption, mandatory exception? Have you understood this mandatory exception? Yes or no? Yeah. Koshiki, whether my audio and video is all right? Pooja, Priyanka, Mr. Ashok, whether audio and video is running fine? Mr. Ashok from ICI support team. Is it running fine? Yes. So ICI support team has also confirmed that it is running fine. And Koshiki has also confirmed that it is running fine. Pooja and Priyanka has also confirmed. So Viraj, I think you need to check your internet connection as well, because this is running fine from my side. Right. Okay. Now let's discuss the next exemption. I hope this is clear to all of you. Yeah. Now let's discuss the next mandatory exception. So Ind AS 106 was optional exemption. NCI was mandatory exception. Now we are discussing third mandatory exception, which is on the estimate, and which is very, very, very important, right? And what is meant by estimate, right? For example, let's say sitting in the current year, you are preparing the opening balance sheet on the transition date and the comparative balance sheet as well, right? So any company which has decided to convert into Ind AS, any company which has decided to convert its accounts under Ind AS, they have to prepare the comparative and they have to prepare the opening Ind AS balance sheet. So roughly, sitting in the current year, they need to prepare a balance sheet which is at least 1.5 years ago, right? So let's talk about provision for warranty obligation. A company which is electronic manufacturing company, right? So they have they have sold goods worth rupees 10 lakh of worth rupees 10 crore, right? And as per the past precedent, they have estimated that 5% will come as a warranty, right? And they have taken a provision in the books of accounts for 50 lakh rupees for 31st March 2018. I'll take an example, 31st March 2018. 1st April 2018 is the transition date, right? And this 1st April 18 balance sheet is technically 31st March 18 balance sheet only, right? So, but you are preparing. So when you have actually prepared 31st March 18 balance sheet, you have prepared in May or June 2018. It means within 3 or 4 months from the completion of the accounting year, within 3 or 4 months. But today, sitting in, let's say 1920, or sitting after 1.5 years, you are preparing 31st March 18 balance sheet, right? So you have a visibility of last 1.5 years, which is after 31st March 2018. Now, standard says that on 31st March 2018, you have taken an estimate in the books of accounts for 5%. But in 1819, actually it went up to 7%. So can you use this 7% while preparing the opening Ind AS balance sheet? So can you restate your provision by 7% while preparing the Ind AS balance sheet? Answer is no. Estimates are the best estimate and judgments, right? 101 says that estimates were required under previous GAAP as well as in Ind AS, right? For example, estimates were required in previous GAAP also. Estimates were required in IGAP also, right? If estimates were required under IGAP as well as in Ind AS, standard says that use the same estimate, right? You cannot change the estimate, right? You cannot change the estimate. It says that use the same estimate, right? Otherwise, probably manipulating the numbers, the company may say that no, I need to change the estimate, right? Don't change the estimate until on the transition date, until and unless the estimate was in error. What is the meaning of this? For example, instead of 10% of provision, or instead of 5% of the provision, the accountant has erroneously applied 0.5%. So this was an error. So if it was an error, error needs to be corrected and it has to be called out separately that this is the impact of the error, right? But if estimates were required under IGAP as well as in Ind AS, like provision for warranty obligation, you are required to use the same estimate, right? You cannot change the estimate on the transition date. Is it clear? Is it clear? I hope this part is clear and this is logical also, because sitting on the current date, you are preparing the old financial statement and you are preparing the transition date balance sheet, and that balance sheet is as at 31st March 2018. So that balance sheet should reflect the situation, the position as on that date only, right? Second, estimate was not required in IGAP but required in Ind AS. In that case, what will happen? Of course, if it was not required in IGAP, it is required in Ind AS, then make estimate, make new estimate in Ind AS, right? You are required to do that. Example, what is the example? Example, lease accounting under Ind AS. You need to estimate lease term. You need to estimate discount rate, right? What is the example of this? For example, above example is provision for warranty obligation. This is required under IGAP as well as in Ind AS, right? If estimate is required under Ind AS, you have to make a new estimate. As simple as that. Estimate was required in IGAP as well as in Ind AS, but measured differently under Ind AS. In that case, what will happen? In that case, what will happen? Measure as per Ind AS. Example, in case of DTA, in case of deferred tax asset, in IGAP, it talks about virtual certainty and convincing evidence. Virtual certainty and convincing evidence. But in Ind AS, the criteria is probable. The criteria is probable, right? Clear? Any doubt so far? Second example could be long-term provision. Long-term provision. For example, in case of claims, in case of legal claims, right? In case of legal claims, for example, you are estimating that I need to pay 10 lakh rupees after 3 years. So the provision is required in IGAP as well as in Ind AS, right? But in Ind AS, it has to be discounted. Long-term provision, legal claims. Rupees 10 lakh is required to paid after 2 years. This is only payment, right? After 2 years. In this case, in IGAP, it is measured at 10 lakh, but in Ind AS, it is measured using the present value. Is it clear? Is it clear or not clear? Please let me know. Is it clear or not clear? Is it clear or not clear? DTA means deferred tax asset. Deferred tax asset. Yeah. Asset restoration obligation is largely aligned because this asset restoration obligation is also required to be discounted using the discount rate. right? Under AS 29 as well. I hope it is clear to all of you. Is it clear, friends? Thanks, Pooja, for your feedback. Viraj, is it clear? Smith, is it clear? Friends, we have discussed three: exemption and exception. Business combination is an optional exemption. Then non-controlling interest is a mandatory exception. Then estimate is a mandatory exception, right? Clear? Let me show you this mandatory exception in the Hindustan Unilever annual report as well. Whether this Hindustan Unilever annual report is visible? Is it visible? Please read this mandatory exception from retrospective application. Please read this. Please read this estimate part. On assessment of the estimates made under previous GAAP financial statement, the company has concluded that there is no necessity to revise the estimate under Ind AS, as there is no objective evidence of an error in those estimates. However, estimates that were required under Ind AS but not required under previous GAAP are made by the company for the relevant reporting dates reflecting condition existing on that date. So they have also written that where the estimates were required under IGAP, we have used the same estimate, right? Except if the estimates were in error, then we have revised the estimate. Or if estimate were not required in IGAP but required in Ind AS, we have made new estimate as per Ind AS, right? Is it clear? Yeah, I have shown you Hindustan Unilever annual report as well. Is it clear? Very good. It's 8:15 now. Let's have a 10 minutes break and we will start at 8:25, right? Let's discuss the fourth mandatory exception or exemption. So the fourth one is derecognition of financial asset and financial liability. I hope I am audible to everyone. Mr. Ashok, I am audible and visible clearly. Okay, thanks. Derecognition of financial asset and financial liability mandatory exception. What is this exception? Right. So friends, now we are talking about, let's say, if something which has already been derecognized prior to transition date, right? For example, there was a company and the company has sold its debtor to a factoring agency on a recourse basis in 2012. Do you understand this? What is meant by factoring agency? So basically, let's say there is a company and the company has a huge amount of trade receivables. The debtors are not paying the money, right? And this is worth rupees 100 crores. So now this company is not able to get the money collected from its debtors. So what they have done, they have hired some factoring agency. They have sold out this data to a factoring agency. Normally what factoring agency do, these are the very powerful people, right? These factoring agency purchased the data from such company which are having a huge debt in their balance sheet, and they do the debt financing. Okay. So basically for 100 crore of data, probably they purchased this data on 50 crores, 60 crores, right? And they got the recovery from these debtors. Like what banks do. Banks sell their NPS to the factoring agency, and the factoring agency used to threaten the customers, used to visit to the customer premises, right? So these are the powerful people. These are the people who have the goons in their teams as well, right? So friends, for example, if a company has already sold out its data to a factoring agency, right? But it was on a recourse basis. Recourse basis means if that customer will not pay, this company has to pay. It means the liability is still there till the time this data will not be collected. The primary liability lies with the company, right? But in IGAP, in Indian GAAP, the company has sold the debtors even on a recourse basis, but still it has been derecognized from the books of accounts in the Indian GAAP, right? And it was long ago. Now the transition date is 1st April 15, and this data has been derecognized from the books in 2012, right? Now the question arises, if something which is derecognized, something which is a financial asset and financial liability, and which has been derecognized prior to transition date from the books of accounts, right? First of all, is it possible to look at the provision of Ind AS 109 or Ind AS provisions to check whatever has been derecognized prior to transition date, whether it should have been derecognized or not derecognized as per Ind AS? Is it possible? Don't go only by this example. In this example, probably you will say that, sir, we are preparing transition date balance sheet on 1st April 15, and this factoring, this selling of data to a factoring agency has happened in 2012 only. So it is possible. But what about Tata Steel? For example, Tata Steel is a 100 years old company, right? So you have to see prior to transition date, you have to see every year that what has been derecognized, what should not have been derecognized. Is it possible? It is not possible. And that is why standard says that 101 says that you have derecognized something prior to transition date. You are not required to check the requirement of Ind AS 109, whether it should be recognized again or it should not be derecognized at that point of time. You are not required to check that. So standard says that apply the requirement of Ind AS 109 from transition date to check whether such assets or liabilities are required to be derecognized or not, right? And it says that apply the requirement of Ind AS 109 from transition date to check whether such assets and liabilities are required to derecognized or not, right? Is it clear or you're not clear on this? Please let me know if you're clear or not clear on this. Yeah. Okay. Pooja is saying I'm clear, sir. What about others? What about others, guys? Let me show you this case study. I hope my PPT is visible. AG Finance Limited had derecognized certain loan assets upon securitization in the financial year 8-9 in accordance with RBI guideline on securitization. AG Finance Limited is a NBFC and they had derecognized some loan assets, right, according to RBI guidelines. And this AG Finance adopt Ind AS from 1st April 18 and accordingly the date of transition is 1st April 17. How would the securitized loan asset be accounted for upon such transition? So according to 109, such loan assets would not have been derecognized, but as per RBI guideline, it has been derecognized. So what we should do? Again, we should restate this loan asset. Answer is no. Why? Because Ind AS 101 says that it shall apply the derecognition requirement prospectively for transactions occurring on or after the date of transition to Ind AS. If a first time adopter derecognize some non-derivative financial asset or non-derivative financial liabilities in accordance with the previous gap as a result of a transaction that occurred before the date of transition, it shall not recognize those assets and liabilities in accordance with Ind AS. Thus, securitized loan assets are not required to be recognized by AG Finance Limited at the date of transition to Ind AS. Right? Clear? Clear, not clear? Clear? Very simple. Just you need to understand that what is given in the standard. The standard only provides you some breather. The standard only provides you some relaxation. That's all. Right? Clear? Very good. Let's go to the next one. Yes. Classification and measurement of financial assets. Very important. And again, this is a mandatory exception. And what are the classification of financial assets? Please tell me. As per Ind AS 109, how the financial assets are classified? Financial assets are classified into three categories, right? What are the three categories? What are the three categories? Amortized cost, fair value through profit and loss, and fair value through OCI. Amortized cost, FVTPL and FVTOCI, right? The entire account financial assets is depending on the classification of financial assets. If it is amortized cost, right, you have to amortize it and you have to recognize interest, right? If it is fair value through profit and loss, you have to remeasure the financial assets every time at fair value. And whatever mark to market is there, fair value changes is there, it has to be recognized in the P&L. If it is fair value through OCI, again, every time it has to be measured at fair value. And whatever mark to market is there, fair value changes is there, it has to go to other comprehensive income, right? So the accounting is depending on the classification, and the classification is depending on the business model and cash flow model. You remember the business model and cash flow model? Yeah. Classification is depending on the business model and cash flow characteristics. And the classification has to be done on the date of initial recognition as per Ind AS 109. What does it mean? For example, today, sitting in 22-23, the company has purchased a financial asset, a government securities, 9 years ago. Okay. So what is the fundamental rule? Fundamental rule is to apply the principle of Ind AS retrospectively, right? Apply the principle of Ind AS retrospectively. Retrospectively means from the beginning of the date of transaction, from the beginning of the transaction. So friends, for example, the company has purchased investment in debenture for 15 years as on 1st April 12, and the transition date is 1st April 20. means 8 years ago. So now I need to find out what is the business model and cash flow characteristics 8 years ago. At the date of acquisition or debenture, what was the intention of the company? I need to find out today. Now you tell me, if I need to find out the intention, what was the intention 8 years ago? And in accounting standard, there was no such requirement of business model and cash flow model, right? There was no such requirement. There was no such documentation. So first of all, is it feasible to identify that what was the intention probably sitting on today? I can say that was the intention at that point of time. So whatever suits me, probably I can say that that was the intention at that point of time, right? Which is not correct. So standard says that it could be a very cumbersome task to find out the business model and cash flow characteristics or cash flow model, which was lying on the date of initial recognition. So what standard has given you a breather? Tell me, what Ind AS 101 has given you as a facility? What Ind AS 101 has given you? Ind AS 101 has told that you are not required to see the facts and circumstances on the date of initial recognition. You are required to see the facts and circumstances on the date of transition for classification of financial assets. तो आपको ट्रांजिशन डेट की जगह आपको क्या देखना है? ट्रांजिशन सॉरी आपको इनिशियल रिकॉग्निशन ट्रांजैक्शन डेट की जगह क्या देखना है? ट्रांजिशन डेट देखनी है. So Ind AS 101 has given you a relaxation. It says that you are not required to facts and circumstances identifying the business model and cash flow characteristics on the date of transaction. You have to look on the date of transition. You are not required to go back in time 8 years, 9 years, 10 years ago. You just need to look at on the transition date, which is just 1.5 years ago. This logical also, this seems logical also, right? You will have a more visibility about 1 year ago rather than about 10 years ago, right? Is it clear? Is it clear or not clear, guys? Have you understood this mandatory exception? So I have told you 5 items so far. Business combination exemption, it was optional exemption, but non-controlling interest estimates, derecognition of financial asset and financial liability, and classification and measurement of financial asset. These are the mandatory exceptions, right? Let's go to the next one, mandatory exception, government loans. What is that? What is that? Example, the company has got an interest-free loan from the government. Now, what is the accounting for that? If a company has received an interest-free loan, what is accounting for that? What is accounting for that, friend? As per Ind AS, what is accounting? If the company has received a interest-free government loan from the government, what is accounting? Interest-free government loan. What is accounting? So the accounting will be as per Ind AS 109 and Ind AS 20, right? Ind AS 20. This is the accounting. What is the general rule? The general rule is if the company is moving from IGAAP to Ind AS, the company has to apply all the requirements of Ind AS since beginning. But as far as government loan is concerned, the Ind AS 101 says that the company can apply the requirement of Ind AS 20 and Ind AS 109 prospectively from the transition date, right? The company can apply the requirement of Ind AS 20 and 109 prospectively from the transition date. But if the company has all the data and information, right? For example, the company has received a government loan 2 years ago. It was interest-free government loan, right? So what is the general rule? Apply the Ind AS 109, Ind AS 20 accounting since beginning. But mandatory exception has been given because government loans could be too old, and the major impact was on public sector undertakings, right? Because if the public sector company got the interest-free government loan 20 years ago, 30 years ago, 40 years ago, 8 years ago, so it was a cumbersome task to apply the requirement of Ind AS 109 and Ind AS 20 retrospectively. So that is why they have said that the company can apply the requirement of Ind AS 20 and Ind AS 109 prospectively from the transition date. But if the company has all the data and information and company wants to apply retrospective, then company can apply it retrospective, right? Now I'll explain this thing with the help of an example, right? With the help of an example. For example, on 1st April 2010, the company has received an interest-free government loan of rupees 10 lakh. Of rupees 10 lakh. Right? Transition date is 1st April 2015. For example, transition date is 1st April 2015. And this is the date on which the loan has been received. And it is an interest-free loan. This is an interest-free loan. The tenure is 10 years. The tenure is 10 years, right? Now the question arises, what is the retrospective calculation of this loan? What is the retrospective calculation, right? And for retrospective calculation, you have to, for retrospective or any, if this is loan, so you have to recognize this loan at amortized cost. Discount rate is, let's say, 10%. Discount rate is 10%. Right? This is discount rate. In this case, if the company has to do the retrospective application, right? What is the present value? What is the present value of this 10 lakh rupees of loan? What is the present value? Let's say today I have received on 1st April 2010, I have received 10 lakh rupees, and after 10 years, I'll pay 10 lakh rupees. It means what is the present value of 10 lakh rupees, which I'm required to pay after 10 years? 10 lakh divided by 1 plus 10% to the power 10, which is years. 385,543.29, right? Present value. On 1st April 2010, I have to apply the requirement of this Ind AS 109 retrospective. So on 1st April 10, I would have done the accounting of what? Bank account debit by how much? 10 lakh rupees, because we have received 10 lakh rupees to interest-free loan by how much? 85,543 to government grant. Right? Which is 10 lakh minus 385,543. Now, next 10 years, what will happen? Next 10 years, let me prepare the schedule for the next 10 years. 31st March 2011, right? 31st March 2012. I'll write as 11, 12, 13, right? This is 10 years. Opening interest closing. What is the opening in 2011? The interest free loan. This interest free loan has to be accounted for as per Ind AS 109, and this government grant has to be accounted for as per Ind AS 20. What is the accounting? Interest will be at 10%, which it was discounted. The closing will be this plus this, right? Please listen this carefully. Please understand this carefully, and it will tantamount to a revision also of Ind AS 109 concept, right? Now in the next year it will become opening, then interest, then this plus this is equal to closing. In the next year it will become your opening. Same. When you do this calculation for next 10 years, at the end of 10 years, this 385 will become your 10 lakh rupees, right? And every year you have to pass an accounting entry of interest account debit to interest free loan account, right? Every year. What is the transition date? Is 1st April 2015. 1st April 15 means 31st March 15. What is the values on 31st March 15? It is 60921. Your value on transition date, by applying Ind AS 109 retrospectively, your interest loan will be interest free loan will be how much? 60921 on the transition date. Is it right? Is it clear? So this is your loan schedule. This is your loan schedule. This is your loan schedule. Okay. Here. Loan amortization schedule. Now let's discuss the government grant amortization schedule. The government grant. Year. Right? So opening amortization, which is taken to your government grant is 614457. Every year you have to take this government grant income. So government grant debit to income. So transfer to income. Closing. What is the opening government grant? It was 614457 on 1st April 2010, right? So divide by 10, because in the 10 years on straight line basis it has to be transferred to the income, so that it will become 0, right? Every year you have to take it to income. So this minus this, right? And this will be your opening, and your government grant will be 614446 only every year, right? So this will become your opening, and every year you have to take this government grant as a 614446. In the last year, you will see that government grant will become zero. Right? So at the end of year, which is on the transition date, what is the value of the government grant lying in the book? What is the value of the government grant? The value of the government grant is will be your how much? 07228, right? If this accounting would have been applied retrospectively, your interest loan would be 62921 and government grant would be 307228. बट ये सारी वर्किंग आपको क्या करनी है? बैकएंड पे करनी है. आपको अकाउंटिंग एंट्री पास नहीं करनी पुराने सालों में जाके बुक्स में, राइट? यू हैव टू डू ऑल दिस वर्किंग ऑन अ बैकएंड, राइट? एंड यू हैव टू टेक द नंबर्स. You have to calculate the number on the transition date, right? On the transition date, your interest free loan and balance of government grant on the transition date is how much? It will come out at 607,921 and government grant is 307,228, right? But On the transition date, which is 1st April 2015, 1st April 2015, what was the amount which was lying in IGAF financial statement? What was the amount which was lying in IGAF financial statement? Interest free loan as per IGAF. Tell me, what was the amount lying in IGAF financial statement? What is the amount lying in IGAF financial statement? Viraj, Chiki, Sumit, is it clear to all of you? I have done nothing. Just I have prepared the loan amortization schedule for 10 years, government grant amortization schedule for 10 years. That's all, right? And I am explaining how this Ind AS 109 accounting and Ind AS 20 accounting happen, right? Clear? So what accounting entry? How do you arrive at the number on the transition date? What is the interest-free loan as per IGAP? As per IGAP, what was the value? In IGAP, it was 10 lakh because there is no discounting criteria in IGAP, right? In IGAP, for this interest-free loan, nothing required to be recognized as a on a present value basis, on a government grant basis. Nothing is required. Right? It will be 10 lakh only, right? In IGAP, the value will be 10 lakh only. What is the accounting entry in IGAP? In IGAP, it is 10 lakh rupees bank to interest-free loan. What accounting entry you need to pass on transition date? You need to pass on transition date. You have to debit interest-free loan as per IGAP. You have to reverse that loan, right? Debit by 10 lakh rupees. You have to credit interest-free loan Ind AS. Ind AS, right? 620921. 2. Government grant. How much? 307228. But still, some balance is still lying. It is 928150 only. Where the difference will go? The difference will be 2. Retained earnings. This minus this minus this. 71850. This is the accounting entry, right? Being loan and government grant remeasured retrospectively on the transition date. Have you understood this accounting entry? Have you understood this accounting entry as per the retrospective application? Sir, what is the prospective application now? Because this is a mandatory exception and Ind AS allows the prospective application. What is the prospective application? This was the example of retrospective application. Now, let's discuss the prospective application. If we have to apply Ind AS 109 and Ind AS 20 prospectively from the transition date, prospective application from the transition date. What is a loan? What is a loan as per IGAP on transition date? So transition date is your loan has been taken on 1st April 2010 for rupees 10 lakh. Right. Transition date is 1st April 15. Okay. It is interest-free loan, tenure is 10 years, and discount rate is let's say 10%. Right. Tenure is 10 years. But what is outstanding? What is outstanding period from transition date? What is outstanding period from transition date? It is 5 years. 5 years. We need to calculate the present value of the loan because on the transition date, it is 1st April 15. We have to pay out after 5 years. So what is the loan value today? It is 10 lakh rupees. So I have to pay 10 lakh rupees after 5 years also. Assuming the date started from transition date, I need to compute the present value on the transition date. So present value on the transition date. In the earlier case, we have calculated the present value on the date of initial recognition. But now we will compute the present value on the transition date. What is that? 10 lakh divided by 1 plus discount rate, which is 10%. But instead of taking the power as a 10, we will take it as a 5. Right? So this is present value on the transition date. Clear? So this is present value on the transition date. What? It's interest-free loan. So this is interest-free loan. So the remaining will be 10 lakh minus 620921. It will be your government grant. If you will apply prospectively, what is the accounting entry? The accounting entry will be interest-free loan IGAP account debit, interest-free loan IGAP account debit, to interest-free loan Ind AS, to interest-free to government grant, right? Interest-free loan IGAP account debit 10 lakh rupees on the date of transition, to interest-free loan Ind AS to government grant. See, there is no any retained earning impact. Why? Because you have applied prospectively. But in the earlier case, there was a retained earning impact. Why? Because the interest was calculated at 10%, on the compounded value. And this income was taken on a straight line basis as per Ind AS 20. So there is a difference. Between the value of 10 lakh versus the closing value of interest-free loan and government grant as per Ind AS on the transition date. Right? Have you understood the impact? Have you understood the difference? In this case, what we have done, we have computed the present value on the transition date. Right? We have ignored the earlier period. But in the earlier case, we have done the Ind AS accounting since beginning, compute the numbers on transition date, and we have restated the numbers on the transition date. Right? Yeah. Very good. Prospective application from the transition date. So all are clear on this. What is the requirement of Ind AS? The requirement of Ind AS 101 is, in case of government grant, the company should apply the requirement of Ind AS 20 and Ind AS 109 prospectively from the transition date. But if the company has all the data and information, company wants to apply retrospective, then company can apply it retrospective. Clear? Now coming to one of the most important exemption, right? Ind AS 16, which is your PPE exemption. And again, it is an optional exemption. Friends, in case of property, plant and equipment, what are the exemption which is given? First of all, what is the fundamental rule? What is the fundamental rule, first of all? What is the fundamental rule? The fundamental rule is apply Ind AS 16 retrospectively from the date of transaction, right? Apply Ind AS 16 retrospectively since the date of transaction. So now every company has the PPE, right? So it is very difficult to apply Ind AS 16 since beginning, as I have explained you in the case of Tata Steel. Then what to do? Some exemptions given in the options given in Ind AS 101. What are the options given in Ind AS 101? What are the options given in Ind AS 101? First option, apply retrospective. Apply retrospective. Apply provisions of Ind AS 16 retrospective. Right? Apply provisions of Ind AS 16 retrospective. Clear? Is it the option? This is not the option. But this option is also valid if a company which has been formed 3 years ago, if a company which has been formed 2 years ago, so they can apply it retrospective as well, right? Technically, after amendment in AS 10, right, which was effective from 1st April 2016, now accounting standard 10 has also been changed, and there is no major difference between AS 10 and Ind AS 16, right? So after 1st April 16, the companies which are incorporated after 1st April 16, probably there is no much difference between AS 10 and Ind AS 16. Right? That is one. B. If you don't want to apply retrospective, just take the deemed cost exemption. Deemed cost exemption. What is the deemed cost exemption? What is the deemed cost exemption? The deemed cost exemption means the deemed cost exemption is first, if you cannot apply it retrospective, compute the fair value on the transition date, like Reliance did. Fair value on the transition date. Transition date, right? Compute the fair value on the transition date. But most of the Indian companies has not computed the fair value on the transition date. Why? Because this computation of fair value is not a simple exercise. It's a lengthy exercise and cost compulsive exercise as well, right? Okay. If this is not, then what you can do? Compute the fair value on the transition date, or if you don't want to do the fair valuation, you don't want to do the retrospective accounting, you have one more option. What is that option? Use the carrying value. Use the carrying value of previous gap as opening value under Ind AS on the transition date. On the transition date, right? This is a carve out which we have taken in Ind AS 101. This is a carve out. What is meant by carrying value? Carrying value, you remember the carrying value defined in Ind AS 16. This means cost, original cost minus accumulated depreciation minus accumulated impairment losses. Example, the cost is 100 rupees. The debt is let's say 25 rupees. The impairment was also taken in 1 year. Accumulated impairment is, let's say, 10 rupees. Now, what is my net block? What is my net block? My net block is 100 minus 25 minus 10. Right? So, friend, this will be the opening cost under Ind AS. Under Ind AS, this is not the gross block minus debt minus accumulated impairment. This will become the opening value under Ind AS. This will become the gross block under Ind AS. Opening value under Ind AS. 65 will become the gross block under Ind AS. Is it clear? So if the company is if the company is availing the deemed cost exemption and company is taking the carrying value under previous gap as a opening value under Ind AS, in that case, if subsequently there are the positive indicators, in that case, earlier impairment loss cannot be reversed, right? Why? Because this has become a cost now. This has become a cost under Ind AS. Understood? Clear? Any doubt here? Any doubt? Any challenge? Net book value will become gross value under Ind AS, and impairment loss will not be reversed, which has been booked under IGAP, right? Clear? Net book value will become gross value under Ind AS, and impairment loss will not be reversed, which has been booked under IGAP. Any doubt so far? Now let's discuss two important things here. Let's say the company has 5 classes of assets. Let's say the company has 5 class of assets. And the company wants to apply let's say on 2 class of assets, the company let's say on 2 class, the company wants to do the fair valuation, and for 3 class of asset, the company wants to apply this carrying value exemption. Carrying value exemption. Is it allowed? Is it allowed if the company wants to apply fair value model? I mean to say company wants to do the fair valuation for 2 class of assets, and company wants to apply the carrying value exemption for 3 class of assets. Is it allowed? It is not allowed. It is not allowed, right? The company is not having a cherry pick choice that the company will do. The company is not having any cherry pick choice, right? It is not allowed. If the company wants to apply fair value model, the other class of assets, on other class of assets, Ind AS 16 has applied retrospective. Apply Ind AS 16 retrospective. Okay. So if the company wants to apply carrying value exemption, it has to be there for entire class of assets, right? It has to be there for entire class of assets. So this is not allowed, but this is allowed. Fair value for 2 class of assets, and remaining class of assets, retrospective application of Ind AS 16. So this is not allowed, and this is allowed, right? So carrying value exemption is applicable. Carrying value exemption is applicable on all class of assets. There is no cherry pick case, right? I hope it is clear to all of you guys. Are you getting me? If the company is 5 class of assets, 10 class of assets, 16 class of assets. So on some class of assets, company wants to do the fair valuation, and for other class of assets, the company wants to avail carrying value exemption. It is not allowed. But the company wants to apply fair value model on some class of assets, and on the remaining class of assets, the company wants to apply one Ind AS 16 requirement retrospective. It is allowed, right? But on some part, carrying value is not allowed. If you want to apply carrying value exemption, it has to be to the entire class of assets, right? It has to be there for entire class of assets, not on some class of assets. Clear? I hope it is clear. No cherry pick choice. Okay. Yeah. Friends, if whatever exemption, whatever we have learned this particular property, plant and equipment, this exemption is applicable to intangible asset, investment property as well, right? So this PP exemption is applicable to intangible assets and investment property as well, right? The only thing is, for investment property, fair value option is not applicable because Ind AS 40 prohibits fair value option, right? Clear? And sir, what about CWIP? CWIP, if I talk about CWIP, on CWIP, can we apply deemed cost exemption? Answer is yes. On the CWIP, we can also apply deemed cost exemption. On the intangible asset under development, intangible asset under development, can we apply deemed cost exemption? Can we apply deemed cost exemption? Answer is yes. Right? We can apply. Clear? Let's go to the next exemption. Foreign exchange. There are 2 exemptions in foreign exchange. Now we are discussing optional exemption. PP, intangible asset, investment property was also optional exemption, right? Right? Koshiki, what is not clear? Let me explain again, right? There are what options are given under Ind AS 101. First, Ind AS 101 says that if you cannot apply retrospective requirement of Ind AS 16, either you can apply retrospective or what you can do, you can apply the deemed cost exemption. What is the deemed cost exemption? First, you need to compute the fair value on the transition date, right? You have to get the fair valuation done and take those values, those fair values as the opening value under Ind AS. If not, you don't want to get the fair valuation done, in that case, whatever closing value as per IGAP is there, that will become your opening value under Ind AS, right? So this part we have understood very clearly, Koshiki. This part we have understood, right? But for example, the company has five class of assets. The company has furniture and fixture. The company has land, building, machinery, right? Some aircrafts. So if the company has 5-6 class of assets and company does not want to do the fair valuation done for every class of assets, for example, for land and building, the company can get the fair valuation done very easily, right? So company wants to apply fair valuation model for land and building, but for aircraft, furniture, fixture, plant and machinery, the company wants to apply the carrying value exemption. Means whatever previous gap value is there, the company wants to make those value as an opening value under Ind AS, right? So friends, standard says that it is not allowed. It is not allowed means you cannot do the cherry picking of fair valuation on some class of asset and carrying value exemption on some class of asset. That is not allowed, right? That is not allowed. So the company has 5 class of assets. So let me clarify this more. The company has 5 class of assets and the company wants to apply different model for valuation on the transition date, right? On 2 class, company wants to fair value. On 3 class, company wants to apply carrying value exemption. Carrying value exemption means the previous gap value is the opening Ind AS value. So this is not allowed. This is not allowed. But the company wants to apply fair value on 2 class and retrospective requirement of Ind AS 16 on the remaining classes. That is allowed. So this is allowed. Okay. So this is what I have explained. So carrying value exemption is applicable on all class of assets. There is no cherry pick choice. If the company wants to apply carrying value exemption, so it has to be on all class of assets, right? Again, let me write one more. Okay. Carrying value exemption. Carrying value exemption. This is also allowed, right? This is also allowed. Clear? I hope this is also clear. Kosiki, is it clear now? Fair value is not permitted on investment property. In that case, either retrospective requirement of Ind AS 40 or taking the deemed cost exemption, right? For all the investment property, the company has taken deemed cost exemption. Now let me show you the Hindustan Unilever annual report, and here you can see this deemed cost exemption for PP and intangible asset. Please look at this deemed cost exemption. The company has elected to measure all its PP and intangible asset at the previous gap carrying amount as its deemed cost on the date of transition to Ind AS, right? Hindustan Unilever has also done that. Clear? Is it clear? Shall I move forward? Okay, very good. Right, now let's discuss the exemption for foreign exchange. Friends, very simple exemption for foreign exchange, right? Foreign currency translation reserve. You understand foreign currency translation reserve? So for example, the parent company is reporting in India. Parent company is preparing financial statement into INR. The subsidiary company is in US dollar, right? In that case, the company has to translate US dollar into INR, right? And every time when you will translate US dollar into INR, you will have some foreign currency translation reserve. You will have some foreign currency translation reserve, FCTR. So friends, Ind AS 21 talks about functional currency approach. Ind AS 21 talks about functional currency approach. And when you read Ind AS 21, it says that every year on the every reporting date, you have to see what is your functional currency. For example, I am a company located in India. And in the current year, my business is largely in France, or my business is in Russia, right? Due to the Russia-Ukraine war, I have shifted my business from Russia to, let's say, America, right? Due to inflation in the next year, I have shifted my business from America to China. So see guys, because this functional currency concept is more from the economic environment perspective. It is not from the geographical environment perspective, the company where it is located, right? It is more from the company where it is doing a business. So the functional currency, when I'm doing a business in Russia, it was Russian currency. When I started business in USA, it was US dollar. When I went to China, it was Chinese yuan, right? So when your functional currency is changing every time, of course, when you are doing translation, this FCTR will also change, right? And what is the fundamental rule? Apply all the provision of Ind AS 21 retrospectively. For a company which is like Tata, for a company which is Tata, for a company which is Reliance, is it possible to go back in time and to check every year what was the functional currency? Is it possible? Answer is no, next to impossible. So that is why Ind AS 101 has given you a very simple rule. What is that simple rule? On the date of transition, whatever foreign currency translation reserve is there as per IGAP, make it zero. Right? Identify the functional currency on the date of transition, right? And apply provision of Ind AS 21 prospectively after transition date, prospectively. But whatever is lying on 31st March 2018, example, transition date is 1st April 18. So on the date of transition, whatever FCTR is lying in IGAP books, make it zero. What is the accounting entry? For example, 100 rupees of FCTR is there, the credit balance, FCTR account debit to retained earning 100 rupees. You have to take it to the retained earning, that's all. And now you have to start your life under Ind AS 21 as a fresh life. Is it clear? So this is a rule which was given in IFRS 1 and Ind AS 101. Is it clear? Very simple thing. Just whatever FCTR is there, make it zero. Many companies have made this FCTR zero on the date of transition. And they have started calculating fresh FCTR as per the new functional currency after the transition date. Right? I hope it is clear to all of you. Now, what is the second exemption in the area of foreign exchange? Please write down. This is the only exemption which is applicable on the adoption date, not on the transition date. Every exemption, every exception is applicable on the transition date. This is the only exemption which is applicable on the adoption date. What is that? You all are aware about para 46 and para 46A of AS 11. Friends, I hope I have made you clear about these exemptions. Yeah. Friends, under AS 11 accounting standard IGAP, there was two paras, para 46, para 46A. Para 46A says that if there is an exchange difference on the long-term foreign currency loan, it has to be deferred and amortized in P&L. And this para 46A came in 2011-12. when the dollar and rupee was changing very rapidly, when the dollar is changing very rapidly, right? The price of the dollars. So exchange difference on long term foreign currency has to be deferred and amortized in P&L, right? Para 46 says that no, you, if you want, you can charge it to P&L. Complete exchange difference, you can charge it to the P&L. But Ind AS 21 says that no. Ind AS 21 says that nothing has to be deferred and amortized to in P&L. Ind AS 21 says that everything should go to P&L. Everything shall go to P&L. All exchange difference shall go to P&L. Ind AS 21 says that. Now, what is Ind AS 101 exemption? Ind AS 101 exemption is apply the requirement of Ind AS 21 retrospective. For example, if a company has taken a long-term loan 10 years ago, so it doesn't matter what accounting treatment, 46 or 46A. If the company was applying para 46, then the accounting is similar, because para 46 also says that you have to take it to the P&L, and Ind AS 21 also says that you have to take it to the P&L. But a company which was deferring and amortizing in P&L, right? In that case, the company has to go back in time and apply this Ind AS 21 accounting since last 10 years or 15 years. For example, if the company has taken a loan 2 years ago, then the company can do that, right? But if the company has taken a loan 20 years ago, 15 years ago, it cannot do that. So in that case, standard says that. Standard has given you one option. What is the one option? Standard says that continue the same accounting policy of exchange difference. Same means 46A or 46. Continue the same accounting policy of exchange difference on the loan taken before beginning of the Ind AS reporting period. What does it mean? What is meant by Ind AS reporting period? For example, if on a company Ind AS is applicable from 21-22, what is the comparative date? 2021. What is the transition date? 1st April 20. This is the transition date. As I told you, all the exemption and exceptions are applicable from the transition date. But this is applicable from beginning of the reporting period. Adoption date. What is the adoption date? Beginning of the reporting period means 1st April 21. This is known as an adoption date. Or this is also known as a beginning of the reporting period. Beginning right, this 1st April 21 is known as the beginning of the reporting period. Is it clear? Let's discuss with the help of this example. Transition date is 1st April 19, comparative period is 1920, reporting period is 2021, beginning of the reporting period is 1st April 20. The company has taken a USD loan. The company has taken a USD loan of $700 on 15 January 20. Means before reporting period, right? On this loan, the exemption will be applicable, right? Whatever accounting the company is following under IGAP, the company can continue to follow under Ind AS. But $300 loan, the company has taken on 30th June 20, which is after the beginning of the reporting period. On this, exemption will not be applicable. Exemption will not be applicable. Ind AS 21 provision will be applicable. Is it clear? Is this clear or not clear? Please do let me know. I'll explain it again. Viraj, Sumit, Soham, Kushiki, is it clear or should I explain it again? I'll wait for 30 seconds. Kushiki is saying clear. Soham, Sumit, Viraj, are you clear on this exemption? Are you clear on this exemption? Okay. Viraj, in accounting standard 11, there are two options. One, para 46 says that whatever exchange difference will be there on long-term foreign currency loan, you have to take it to the P&L. 46A says that whatever exchange difference on foreign currency loan is there. You can defer and amortize in the remaining period of the loan, right? For example, in the current year, the exchange difference is 1 lakh rupees and the outstanding tenure of the loan is remaining period of the loan is 5 years. So you have to amortize this 1 lakh rupees in the next 5 years, 20,000 every year, right? But Ind AS 21 says that Ind AS 21 is similar to para 46 of AS 11. It says that you have to take all the exchange difference to P&L, right? So for example, if I am applying 46A in IGAP and I have taken this loan 10 years ago, so I need to apply the Ind AS 21 accounting retrospective, and every year I need to check if I would have applied Ind AS 21 retrospective, what should go to the P&L, and the total impact I should take it to the retained earning on the transition date, right? But Ind AS 21, but Ind AS 101 has given one exemption. What is that exemption? Ind AS 101 says that continue the same accounting policy of exchange difference on the loan taken before beginning of the Ind AS reporting period. Ind AS reporting period means current year, right? Means before adoption date, whatever loan you have taken, you can apply the same accounting what you are applying in IGAP. This is the exemption which is given. And you can understand from the help of this example as well. Transition date is 1st April 19, comparative period is 1920, reporting period is 2021, beginning of the reporting period is 1st April 20, which is adoption date. Adoption date, right? So 700 US dollar loan has been taken before adoption date. On this exemption will be applicable. But $300 loan has been taken after adoption date. So on this exemption will not be applicable. Right? I hope it is clear now. Let's go to the next exemption. Non-current asset held for sale. Friend, when I taught you non-current asset held for sale under Ind AS 105, what is the requirement of Ind AS 105? The requirement of Ind AS 105 is you need to compute your non-current asset held for sale at the lower of fair value less cost to sell or carrying value, right? It means 105 requires to compute the fair value of the non-current asset held for sale, right? Now the question arises, let's say the transition date is 1st April 20 and the company has classified a non-current asset held for sale on let's say 1st October 2019, right? So standard requires that you have to compute fair value less cost to sell on the date of classification as held for sale, right? This is the requirement of Ind AS 105. What exemption Ind AS 101 has given? Ind AS 101 has given that don't go to the date of classification. You can compute your fair value less cost to sale of the non-current asset held for sale on the date of transition as well, right? So on the date of transition, you can compute the carrying value which is already there, and you can compute the fair value less cost to sell, whatever is lower. On that value, you can measure your non-current asset held for sale. So Ind AS 101 has given an exemption from where it has just shifted from the date of classification as held for sale to the transition date for the purpose of computation of fair value less cost to sell. That's all. Sir, what happens if the company wants to apply it retrospective? It is always there. It is an optional exemption. It is not a mandatory exception. It is an optional exemption, right? It is not a mandatory exception, right? But the only breather is, for example, if the company has classified an item as a held for sale 3 years ago, so you're not required to go back to 3 years ago. You can just compute fair value less cost to sell on date of transition, compare it with the carrying value, and you can apply this requirement from the transition date. That's all. Non-current asset held for sale, is it clear? Is it clear? Non-current asset held for sale? Now the last exemption which I am talking about is the subsidiary adopt Ind AS after parent, which is very important exemption, right? Okay, everything is clear to everyone so far. As far as the feedback I have received from 5-6 participants. Yes, now let's discuss this. For example, there is a parent, right? The parent is applying Ind AS. The parent is applying Ind AS from 1st April 2020. Right? From 1st April 2020. There is a subsidiary. Subsidiary is NBFC. Subsidiary is NBFC. And this subsidiary is applying AS for the statutory purpose, right? This subsidiary is not applying Ind AS. This subsidiary is applying AS. Okay? But subsidiary prepared Ind AS accounts for the purpose of consolidation of parent, right? But for the statutory purposes, the subsidiary is only preparing AS accounts, right? But parent is preparing Ind AS account for the statutory purposes, right? I hope it is clear to all of you. Now, on this subsidiary, the requirement to prepare Ind AS account is from 1st April 2021. The subsidiary is preparing Ind AS account from 1st April 2021. Right? Now let's discuss about the parent company. Parent company standalone and parent company consolidated financial statement. Parent company is applying Ind AS, right? Parent company is applying Ind AS. Parent company will apply Ind AS from which date? It is applying from 1st April 20, means 2021 is the first year, right? Again, for console, 2021 is the first year. If 2021 is the first year, what is the comparative date? 19, 20. Then what is the transition date? 1st April 19. 1st April 19, right? 1st April 19. For CFS purposes, NBFC subsidiary will also prepare Ind AS financial statement for these periods, right? So the CFS purposes, the subsidiary will prepare standalone accounts 2021, 1920, and 1st April 19. Otherwise, how the parent will prepare console? Is it clear to all of you? Is it clear or not clear? Yeah. Clear? Now, this subsidiary, for the statutory purpose, subsidiary is preparing AS account. But for Ind AS purpose of parent, control of parent, the subsidiary is preparing standalone account, right? Standalone account, the subsidiary is preparing this standalone accounts, right? For 2021, 1920, and 1st April 19. Now what happened? For regulatory purpose, subsidiary will publish its Ind AS account from 1st April 2021. What is the period for subsidiary for standalone regulatory purposes? It is 2021, 22. The comparative is 2020, 21, and the transition date is 1st April 2020. Friends, the above part is clear. Parent is preparing Ind AS from 1st April 20, and the subsidiary is preparing from 1st April 21, right? So for the regulatory purposes, they have to prepare the first Ind AS account. They have to publish first Ind AS account 21, 22, 2021, and 1st April 20 as a transition date, right? As a transition date. Now the question arises, when the subsidiary has prepared Ind AS financial statement for the purpose of parent, the subsidiary has assumed the transition date of 1st April 19 and accordingly subsidiary has prepared the transition first Ind AS account for the purpose of parent. Now subsidiary has to again this Ind AS account considering the transition date as 1st April 20, which is regulatory transition date. So whether the subsidiary has to, now what are the options available to subsidiary? What are the options available to subsidiary? First option for subsidiary is option number 1. Subsidiary will apply Ind AS 101 from 1st April 20. Subsidiary will apply Ind AS 101 from 1st April 2020. From 1st April 2020, right? Means subsidiary will apply all the exemption exceptions from 1st April 2020, right? You can see that first subsidiary will apply this Ind AS 101 exemption and exception on 1st April 19. Now they will apply from 1st April 20. So instead of applying 101 again on 1st April 20, can't they do? They have already prepared 31st March 20 financials as per Ind AS 1920 financial. So whatever number as per Ind AS is there on 31st March 20, it will be 1st April 20 number, as simple as that, right? So जो भी Ind AS का नंबर 31st March 20 को ऑलरेडी है पेरेंट के पर्पज से, वही नंबर यहाँ पर Ind AS का नंबर 1st April 20 को बन जाएगा. So the second option is the subsidiary use 31st March 20 Ind AS balances as an opening balance under Ind AS as on 1st April 20. Subsidiary can use 31st March 2020 balances as an opening balances under Ind AS on 1st April 2020, its transition date. Right? It's subsidiary can use 31st March 2020 Ind AS balances. According to you, what is the appropriate thing? Doing this exercise again on 1st April 20 or just take the 31st March 20 balances as opening balances under Ind AS on the transition date? What is the right thing? According to you, what is the right thing? Option number 2 is the right thing because they have already prepared the financial statement as per Ind AS. In this case, they have to apply option number 2, and in case of subsidiary which is preparing the financial statement after parent, they can use the earlier Ind AS numbers as the opening number under Ind AS, right, on the transition date. So this is what we have discussed in the transition date balance sheet, right? These are the exemption and exception which you have to apply on the transition date balance sheet. I hope it is clear to all of you guys. Yeah, is it clear? And I have also told you that how this Ind AS conversion has to happen, how this impact has to be taken to retained earning and deferred tax as well. So I've already explained this part to you, all of you, in the beginning of the session itself. Now you understood the concept of transition date, the concept of accounting policy, recognition, derecognition, measurement and classification criteria on the transition date balance sheet, and applying the optional exemption and mandatory exceptions, right? And how to take the impact in the reserves and surplus in the retained earnings. So we have discussed all these part. Now let's discuss the disclosure part. What is the disclosure requirement? First time adopter shall explain how the transition from previous GAAP to Ind AS affected its financial position, performance and cash flows, right? You can see that in Hindustan Unilever annual report, you can see that they have completely explained. First of all, they have given a separate section, first time adoption of Ind AS, where they have explained that they have done the first time adoption of Ind AS and they have restated the comparative and given the opening balance sheet. Then they have also explained what is the mandatory exception and optional exemption, right? And then they have explained what are the reconciliation which have been given, which I have shown you in the last class. Then they have explained the reconciliation also, balance sheet reconciliation, P&L reconciliation. Wherever there was a change, they have explained the changes also, right? So they have explained the entire transition. Right? This way they have explained the entire transition. So reconciliation are required to be disclosed on the date of transition and on the comparative date for balance sheet, for the P&L, right? For the cash flows as well, right? These are the Maruti Suzuki India Limited disclosures. This is what I have given. Now let's time to recap. Identify in the Ind AS implementation assignment is identify applicability of Ind AS, evaluate on the basis of criteria, net worth criteria. Identify transition date because 101 is largely applicable on the transition date. This is the first date from where the Ind AS journey will start. Applicability of the standard on the reporting date. Whatever standards are applicable, it has to be applied throughout the first Ind AS financial statement, right? Recognition, derecognition, reclassification, and measurement is for Ind AS on the transition date. Apply Ind AS standard retrospectively, except availing of optional exemption and mandatory exceptions, right? Explicit and unreserved statement of compliance has to be given in the first Ind AS financial statement. It has to be given in the subsequent Ind AS financial statement also as per Ind AS 1. Then the disclosures are what? Reconciliation, right? How this Ind AS has impacted the transition. So impact has to be explained, reconciliation has to be explained, what exceptions and exemption has been taken, that has to be explained, right? This is what we have discussed in Ind AS 101. Please let me know if you have any query, any doubt. I will be happy to explain that in the next 1 minute. Otherwise, I will be concluding this session in the next 1 minute. Kostiki, what is your question? Is it mandatory? What is that which you want to know? Right? Beginning in subsidiary, both options are available. Yes, both options are available. These are the options. This is the optional exemption, right? Either consider the new transition date as a fresh transition date and apply Ind AS 101 again, or take the comparative date balances as a opening Ind AS balances under this regulatory transition date, right? I hope you have enjoyed the session. I have shown you the Reliance Industries annual report in the last class and Hindustan Unilever annual report in the current class. Thank you so much, guys. Stay safe, stay happy. All the best for your examination. Bye bye. Take care.